Hey, everybody. Welcome back to another episode of the Climb Finance Show. This is your host, Kian Lynch, and today we're going to be talking about the regional banking crisis, as some people are calling for. However, I don't believe that this is going to manifest, and we'll talk about why. Here are some headlines that we will get into right now. So, some of these headlines: downgrade stirs concerns of regional bank failures. New York Community Bank stock plunges 40%, reigniting fears for regional banks. Wall Street's worried about another crisis. You might remember a year ago there was a regional bank crisis in which several community banks and regional banks went under due to rising interest rates. Essentially, these banks had dealt out loans back when we had zero interest rate policy a few years ago. And then when the Federal Reserve increased rates very quickly, it became more expensive to borrow, and these banks were unable to refinance their loans, essentially holding on to, they were losing money in their lending books. And so we have another thing going on right now. New York Community Bank Corp, one of the largest regional banks in the United States, if we take a look at its stock chart since the beginning of the year, is down from $10 2 weeks ago to $4.50. So it is plunging. There's a few reasons why this is happening. Essentially, they released an earnings statement 2 weeks ago where they were losing all this money on their commercial real estate loans. And we'll get into that in a second. But I just wanted to show this is an index comprising of other regional banks in the United States. Again, looking at the year to date, it's down in the last 2 weeks since the beginning of the month, or last 10 days rather, over 10%. So something's certainly going on. And I wanted to just read through a few things in this New York Times article, which gives us some more details. Why this was published like 2 days ago, updated yesterday. Why one shaky bank is stirring fears of a wider financial mess. New York Community Bank plunging stock highlights risks that loom over lenders large and small, showing the stock price. The 1-year anniversary approaching of a crisis that brought down several mid-sized banks. Another lender is putting unwelcome attention on the industry, releasing statements trying to bat down concerns about its financial health, released an ugly earnings report last week that included unexpected losses on real estate tied to both office and apartment buildings. Essentially, shares of other lenders with portfolios of commercial real estate have dropped. And here's what you need to know. Essentially, like as I said, they have released all of these earnings that show that they've lost a lot of money on commercial real estate. They've lent a ton of money, and they're not being repaid. Moody's has downgraded the bank's credit rating, and what it really comes down to is this little article, this little paragraph right here. A large swath of lenders, including community banks and private lenders, could face losses linked to commercial real estate due to these loans that were made before the move to remote and hybrid work during and after the pandemic, which have put on pressure on landlords and caused the value of the buildings to drop. The rise in interest rates for the past few years has also made it more expensive to refinance such loans. Larger banks are also setting aside money to deal with these losses, but they're able to withstand a larger downturn due to a diversified base of lending and deposits. So essentially, it's the regional banks that are being hit the hardest. Federal Reserve Chairman Powell had an interview this week. He said that a real estate-led banking crisis is unlikely, and some smaller and regional banks are challenged, but the central bank is working with them. They've been aware of this for a long time, so they know exactly what's happening. And I don't think there's any risk of a bank run. Um, this is an important article from 2 weeks ago talking about the emergency bank lending program, which is set to expire in March, in mid-March. The Federal Reserve on Wednesday said a funding lifeline created for banks last year after the collapse of Silicon Valley Bank would close as scheduled in March. Essentially, this was a lending program called the Bank Term Funding Program that the Fed set up during last year's regional bank crisis. It was designed for emergency situation. However, even though it was designed to make sure banks and creditors would have the liquidity they need, but it's coming to an end. And I think that this announcement is directly tied to what we're seeing with regional banks, because with this was a liquidity lifeline designed for the regional banks. It's now being taken away. The Fed knows exactly what's going on here. Of course, we would expect the Fed to decrease interest rates this year, but again, they, as of yesterday, Fed policymakers signal no rush to cut U.S. interest rates. We know they're coming this year, but the question is, are they coming in March? It's pretty obvious regional banks need a rate cut because, financing rates are just too high right now. And they have these bad loans that they need to try to get off their books because commercial real estate has not rebounded. There's been a lot of companies, corporations pushing for the return to office, but commercial real estate is still suffering compared to pre-pandemic levels. So yeah, it's just a question of when is the Fed going to cut? They are holding off on cutting interest rates until they have more confidence that inflation is headed down to 2%. Gave a range of reasons for feeling a little urgency to start easing policy soon. I mean, the collapse of regional banks would be a reason to start increasing or lowering interest rates. His colleagues appear to agree. It's just a question of when are they going to decrease interest rates or renew the bank term funding program or create some type of new liquidity process. But again, I'm not really that worried. I am not all that worried about this. In the short term, yes, but I think that the Fed knows what they're doing. It's an election year. The stock market's in an interesting place. The S&P 500 is near all-time highs. Same with the Dow Jones, right at all-time highs. It's kind of at an inflection point. Either we break through these all-time highs or we get kind of screwed. Looking at Bitcoin, which is so dependent on liquidity and low interest rates, same with growth stocks. Bitcoin's had a great February, back above 45,000. I see this as one of the most forward-looking assets, and this asset class truly has an eye on liquidity programs, whether it's coming from the U.S. or potentially from other markets, such as China. China's economy seems to be just getting devastated. This is an article from yesterday. China's prices fall at fastest rate in 15 years as economy battles deflation. It seems like China is going to need its policymakers to revive investor confidence, whether that's some type of liquidity injection or lowering interest rates. Who knows what they're going to do over there. But ultimately, I expect policymakers to not allow another crisis to occur. I think the Fed will step in soon enough. Either the Fed or the Treasury will step in with some type of liquidity injection or cutting interest rates before the end of March. February could be an ugly month, but I think for investors, if you're able to deal with a tough February, I think March should be pretty green across the board. And if it's not going to, the liquidity is not coming from the Fed, then I think for some markets like Bitcoin or others, I think liquidity could be coming from overseas as countries are trying to deal with, faltering economies in the United States. It's an election year. I think Democrats are going to try to bolster the economy heading into the election. And I mean, look at China. Consumer price index fell 0.8% in January, the fourth straight month of declines, and the biggest contraction since 2009. A multitude of indicators now flashing red. It's not looking great over there. And they're also being just hammered by a decline in real estate prices. So deflationary pressures are weighing on corporate earnings and fueling a stock market rout. But, with all this, type of negativity going on, specifically speaking for the US, looking around the world, things still aren't that bad. They're actually pretty great. So you got to trust the markets, you got to trust the data, and things are looking solid. And I think once the Fed steps in with some easing or expansionary monetary policy, we should continue to perform well. And that's it for this episode of the Climb Finance Show. Thank you for joining me. I'll be back with an update next week. Have a great one.